Let's talk about investing. Because for something that's supposed to help you build wealth, it's weirdly intimidating. You hear words like stocks, portfolios, capital gains, and diversification, and suddenly it feels like you need a finance degree just to get started. But here's the truth: investing is just putting your money into something with the goal of making more money back later. It's not gambling, it's not guessing, and it's definitely not just for the rich. Investing is how people take the money that they already have and make it grow over time instead of letting it sit in a savings account. So today, we're breaking down where to start, how to tell if an investment is actually good, the difference between short-term and long-term investing, how risk and reward work, what compound interest does, the difference between stocks, bonds, ETFs, and mutual funds, and how taxes play into all of this. The biggest mistake beginners make is thinking that they need a lot of money to start investing. You don't. Thanks to investing apps and brokerages, you can start investing with as little as $5 to $50. Most platforms now allow fractional shares, which means you don't have to buy the entire stock. You can own a small piece of it. Before you even invest anything, there are two things you need to have in place: an emergency fund and no high interest debt like a credit card balance. Once those things are handled, you'll need to open an investment account. This could be a brokerage account or retirement account like a Roth IRA if you're eligible. Now, before you invest, you need to know what you're actually putting your money into. Let's start with stocks. When you buy a stock, you're buying a small piece of ownership in a company. If a company does well, the value of the stock can go up, but if the company struggles, the value can drop. Stocks are generally higher risk, but they also have higher growth potential. Next are bonds. Bonds are basically loans. When you buy a bond, you're lending money to a company or the government, and they pay you back with interest over time. Bonds tend to be lower risk than stocks, and they also grow more slowly. Now let's talk about mutual funds and ETFs, because these are what most beginners start with. A mutual fund is a collection of investments, like stocks or bonds. They're managed by professionals. Instead of investing in one company, your money is spread across many investments, which helps reduce risk. An ETF, or exchange traded fund, is very similar. It's also a bundle of investments, but it trades like stocks on the market. ETFs also have lower fees and can be bought and sold throughout the day, while mutual funds are typically traded at the end of the day. Now let's talk about the real reason investing works: compound interest. Compound interest is when your money earns returns, and then those returns start earning returns too. So if you invest $100 and earn 10%, now you have $110. The next time you earn 10%, you're earning interest on the full $110, not just the original $100. Over time, this creates a snowball effect where your investments grow faster and faster, not because you're putting in more money, but because your money is working for you. A good investment is not trending on social media or being hyped up by influencers. A good investment is something that fits your financial goals. Ask yourself, do I understand what this investment is? Is this short-term or long-term growth? What's the historical performance? What kind of fees are involved? Diversification is also important, meaning you're not putting all your money into one type of investment. Short-term investing usually means you're investing for a goal that's less than 3 to 5 years away. The problem with short-term investing is that the market goes up and down, and if you need your money during a downturn, you could be forced to sell at a loss. Long-term investing gives your money more time to recover from those dips and benefit from compound growth. Every investment comes with some level of risk. The general rule is the higher the potential reward, the higher the risk. Low-risk investments like bonds are more stable but grow slowly. High-risk investments like individual stocks have the potential for higher returns, but they can also lose value quickly. The key is balancing your investments so the risk level matches your goals. When you sell an investment for more than you bought it for, that profit is called a capital gain, and it could be taxed. If you hold investment for less than a year before selling it, it's taxed like regular income. If you hold it for more than a year, it's taxed at a lower rate. So holding your investments longer can actually help you reduce how much you owe in taxes. Investing isn't about being perfect. It's about getting started and staying consistent. Start small, stay invested. Diversify your portfolio, and give your money time to grow. If this episode helped you understand investing a little bit better, follow the podcast for more real-life money conversations. And that's Fitch Girl Real Talk.